I'm Brittany. Madison.
Steven.
Wayne.
Hi, I'm Jaden Stabler. According to Rebecca Lake, personal finance reporter for The Balance, student loan debt has reached astronomical levels in the U.S., with 44.2 million Americans carrying an estimated $1.48 trillion in education debt. The average class of 2017 graduate left school with $39,400 in student loans. With most jobs requiring a degree, this statistic is scary to think about, since to get a good paying job, you must also acquire a significant amount of debt to go hand in hand with your degree. Along with personal hardships, there is also the factor that because younger generations cannot spend as much money on products, from things as little as groceries to things as big as mortgages, this has significant consequences on the economy. In today's speech, I will be discussing why the U.S. government should reduce student debt to allow consumers to pursue better opportunities, to stimulate the economy, and to help diversify other types of debt, as well as possible solutions and plans that have already been proposed recently by politicians. If student debt was reduced, it would allow consumers to pursue better opportunities. Being able to start a family, traveling the world learning about different cultures, and pursuing new hobbies all take money. That is money that recent graduates cannot spare. Having massive amounts of student debt puts a damper on one of the most important phases of a human's life, young adulthood. According to Student Loan Report, more than 2/3 of respondents, 68%, said their student debt restricted their ability to take a vacation, while more than 1/3 of respondents, 34%, said student debt had forced them to put off or delay starting a family. It was also reported that keeping up with daily expense was an issue for 41% of respondents. Also, reducing student debt would help boost the economy. Since the younger generation would no longer have a large monthly payment to commit to, they would be able to either save the money and earn interest or spend that money on larger investments such as houses or cars. It would also persuade these young people to use credit cards, leading to greater interest and free revenue for banks and lenders. Another upside would be a more educated workforce, since college would become more accessible to the lower class. According to Mark DiMaggio from the Harvard Business School, these people get better jobs and spend more money, and this money goes back into the economy. Those things should be taken into account when evaluating policy interventions aimed at addressing the student loan problem. He also states that people with a lot of student debt are more fragile and they postpone other life choices, like moving, buying a house, or getting married. When that debt is gone, people feel more freedom to make a change with their careers and get their acts together financially. Patrick Healy, founder and president of Caliber Financial Partners, says that though student debts typically can't be discharged in bankruptcy, betting on any unsecured debt can be a risky investment. Experts believe that student loan defaults have the potential to adversely impact the U.S. economy, which could trigger another recession. A real-world example of this can be seen after World War II, when Franklin Roosevelt, after seeing the state of the country, took direct action. After the Great Depression, the economy was stagnant. With growth nowhere in sight, Roosevelt realized that to get some, you must also give some. He created programs and put money back into the economy by creating social programs for underprivileged people to bridge the gap between the lower class, who could not afford the same things as the upper class. In modern times, the lower class is the younger generations, the upper class being the older generations. Student debt is being reduced would also help to diversify other forms of debt. Without the need to pay off extensive amounts of education debt, graduates could devote more of the money to paying off other kinds such as mortgages and car loans, allowing them to begin adulting sooner. Instead of putting money into a school loan, people would put money into buying a house, buying a car, etc., which would boost the overall economy by providing more jobs and increasing the consumption of goods and services. In fact, student debt is the second largest consumer debt in the U.S., trailing only mortgage loans, and surpassing car loans, credit card debt, and home equity lines, according to Forbes.com. There are multiple solutions to reducing student debt, some short-term and some long-term. The Great Recession in 2008 caused state funding to go down each and every year since then, which is the main reason for the spike in tuition costs. So increasing the involvement of the states in providing money for education would be one of the best chances of reducing college tuition costs. Daniel Johnson, professor of public policy and economic development at the University of Toledo, states that State funding and subsidies were cut by more than $7 billion between 2008 and 2018. What many call the privatization of public higher education has shifted most of the state's share of instructional costs to students and their families, with disruptive results for both students and institutions. Other solutions could be allowing employers to pay off their employees' student debt in a way that it would be both tax advantaged to the employer and the employee. There is also the possibility that providing more online programs could reduce college tuition by not requiring the students to pay as much for their education. An emphasis on vocational schools being an option could also force universities to keep their tuition low as an incentive. The modern mindset is that you must have a college degree to be successful, leading less and less people to enroll in vocational schools where they are taught specific skill sets, such as mechanics, welders, electricians, and other critical jobs. On the other hand, requiring companies to hire a certain percentage of employees who don't have a college degree could ensure that even the people who don't have enough money to go to college are able to find a good job. The student debt crisis in America is an issue that needs to be addressed now, before it gets worse. The U.S. government reducing student debt has many benefits, including, but not limited to, allowing consumers to pursue better opportunities, stimulating the economy, and helping to diversify other types of debt. There are many possible solutions to solve the crisis, but it is not a one-size-fits-all kind of issue. We need to be discussing what's best for all Americans. Not only has tuition gone up, but also housing and fees, with most universities requiring freshmen to live on campus. This added expense is costly and should be optional. This is not just an issue for people with kids going to college. Student debt affects everyone. If the solution is to increase taxes, then people who choose to not have kids are going to have to help pay to send someone else's child to college. It has been over a decade to get to where we are now, so we can expect that it will be another few years before we see any significant improvements. That means that we need to start the movement sooner rather than later. And it all begins with standing up and speaking out about what you believe to be reasonable and fair. As a future college graduate, I can only hope that people start listening to what the younger generations want their future to look like. Thank you.